What is Forex liquidity? Liquidity indicates how active and stable a market is and is primarily determined by trading volume and market participants. In the Forex market, liquidity is important as it affects how quickly and efficiently a position can be opened and closed with minimal price impact. The Forex market is highly liquid due to its massive daily trading volume and its 24-hour operation, which ensures continuous buying and selling. Its global participation and decentralized, over-the-counter nature further enhances liquidity. Liquidity can be influenced by various factors, including firstly trading volume. Higher trading volume in currency pairs like British pound or US dollar increases market liquidity, often making transactions easier and spreads tighter. Second, there are market participants. Higher levels of activity from banks, hedge funds, forex service providers, etc. enhances liquidity. Third is geographics. Liquidity fluctuates throughout the day as different financial centers open and close, affecting trading activity. And finally, regulations. Changes in financial regulations or capital controls can impact trading volumes, leading to shifts in market liquidity. What is a Forex liquidity provider? Forex liquidity providers, often termed as market makers, ensure a continuous flow of buy and sell orders in the Forex market. A liquidity provider is a market participant that holds itself ready to buy or sell currency pairs at any given time, providing two-way prices. They bridge the gap between stakeholders in the market, ensuring that there's always a counterparty available for every trade. Forex liquidity providers have two main classes: market makers, who utilize their balance sheets, and ECN or STP providers, who focus on technological order matching. While market makers provide both buy and sell quotes and often take the opposite side of a trade, ECN or Electronic Communication Network and STP or straight through processing providers act as intermediaries, connecting traders with sources of liquidity without taking positions themselves. Let's talk about high and low forex liquidity. What is high liquidity? A currency pair is considered highly liquid when it can be easily bought or sold without significantly impacting its price due to a high trading volume and a large number of market participants. This means sellers can easily find buyers without needing to lower the price, and buyers can acquire the asset without having to pay extra. In the forex market, highly liquid currency pairs like US dollar or euro usually maintain a steady flow of transactions, allowing trades to be executed swiftly and at stable prices. High liquidity generally results in lower forex transaction cost, tighter spreads, and minimal slippage, providing a smoother trading experience. What is low liquidity? A currency pair is considered to have low levels of liquidity when there is limited trading activity and fewer market participants, resulting in lower demand and supply. As a result, large trades can significantly impact the exchange rate. Low liquidity can lead to price volatility and difficulty executing trades at desired levels. In the forex market, low liquidity currency pairs, also known as exotic currency pairs such as US dollar or Turkish lira, often experience wider bid-ask spreads, higher volatility, and potential difficulty in executing large trades without price slippage. Why is market liquidity important? Market liquidity is important because it impacts how price move and your overall risk on a position. A liquidity market tends to make lots of small price movements as the high number of trades impacts its price at any given moment. An illiquid one, on the other hand, might suddenly leap from one price to another thanks to a single deal. Less liquid markets are generally seen as riskier than highly liquid ones. Say, for instance, that you own a large number of shares in an illiquid stock. Your investment isn't giving the return you want, so you decide to sell the shares. However, because the market is illiquid, you struggle to find anyone willing to buy the stock. The low demand combined with high supply from your attempted sale could drive the price of your shares down, forcing you to sell them at a loss. How do forex liquidity providers work? The forex market operates through a network of liquidity pools. with the interbank market being the most prominent. This market comprises the world's largest banks and financial institutions trading vast amount of currencies daily. The main liquidity pool is the global interbank market of larger banks and financial institutions trading vast order flows. Liquidity in the forex market is often categorized into two tiers. Firstly, Tier 1. This comprises major international banks like Morgan Stanley, Goldman Sachs, and Barclays. They offer the highest level of liquidity and are the primary source for most forex transactions. Number 2, or Tier 2. This includes smaller banks, financial institutions, and liquidity providers that act as intermediaries between brokers and Tier 1 entities. Examples include FXCM Pro, CFH Clearing, LMAX Exchange, Refinitiv FX All, Currenex, Integral, and Swissquote. Liquidity providers source pricing and liquidity from these tiers and establish their pools accessible to other entities. The tiered models help to ensure that liquidity is cascaded down from major bank clients to smaller brokers and end users.